For those of you who are wondering, no, this vid is not clickbait. I actually really do believe that gold should be properly valued at $4,000 an ounce. And I'm going to prove it with a little gold valuation model that I've created. But before I start, let me just give you a kind of a backdrop about me. I have been studying economics for the past 10 years. And I really started because I wanted to understand economic crashes and why they occurred, in which that inevitably drew me to gold and silver and other precious metals because, quite frankly, they tend to outperform most other financial investments during economic crises, and they actually become the only type of investment during a severe economic collapse that results in the destruction of a nation's currency. So that being said, most people who believe that our current environment cannot continue as far as economic markets are concerned inevitably turn to start to purchase and hoard gold and silver to save themselves. But if you've ever wondered why gold and silver tend to be, or at least viewed to be, such poor investments, I've got a graph to show you right here on my screen. And I want to break it down a little bit right here. So the red line here is the actual gold fixing price that has been recorded from the London bullion market. And this data is provided by FRED, which is the Federal Reserve Economic Database for St. Louis. And the blue line is a valuation model that I have created for gold. I basically have priced gold as a form of the M1 money supply in circulation, and then factored in the consumer price index. Evidently, obviously, the higher the CPI is, that means the higher our prices are, the higher gold will become. But then you have to factor in the economy. So, you take out the private sector of the economy and factor that against what gold against the money supply and the consumer price index, and you can get a valuation of what gold is. And that's represented by this blue line. And you can see here that during times of high inflation and high debt defaults here in these severe economic crises, like in the early 1980s and the 2008 economic crash, you can see that gold is properly valued according to my model, where the price actually reflects or exceeds the valuation calculation that I've come up with. But during the lulls in between, gold tends to go through a bear market and really tends to be a rather poor investment per se. And the reason why is because during times of economic growth, there are other alternative investments to gold. Those become the opportunity cost of gold, and those are namely stocks and bonds. So, stocks and bonds tend to pay money to the holder of those securities to actually own it. So it's in terms of stocks, you get paid a dividend. In terms of bonds, you get paid an interest rate, and you're actually rewarded for betting that the economy is going to grow, because if the economy is growing and the investment that you have placed your money into is a worthwhile investment, meaning it yields a profitable outcome for the business or organization that you're investing in, then you will yield a return on your investment. Gold is the anti-investment. Same with silver. It's a bet that the economy is actually going to fail. Okay? And so that means that gold will always be undervalued, because the opportunity cost to hold gold during times of economic growth is high. But when there's a breakdown in the economy, such as in high inflation rates of the 1970s and 80s, and to the 2008 economic crisis, which was a result of high asset price inflation and the resulting economic collapse from that, that's when gold becomes properly valued, because the opportunity cost evaporates. Stocks and bonds are no longer attractive. Gold and silver come into play, and a bull market ensues. But I wanted to give you that kind of backdrop before I lay down the valuation, because I don't want to mislead you into thinking that gold will rise to $4,000 an ounce. All I'm pointing out is that gold is properly valued at $4,000 an ounce. and you can see that here in this latest graph. The major uptick in my valuation model is the money supply. So the money supply has exploded. M1 has exploded due to unprecedented monetary and fiscal stimulus that our federal government has injected into the economy. It will fail to create the type of growth that is necessary to get us out of this rut that we're in, because quite frankly this crash was caused by government imposed shutdowns. Only until those shutdowns are lifted will we not go through a true recovery. We will not go through a real economic recovery until we are allowed to fully reopen whenever the government thinks that may be. So until then, the Fed and the government can continue to spend and print endless amounts of money, and it won't do any good. And so right now, gold is, I've got gold actually valued over $4,000 an ounce. But once you factor in a Q3 bounce back, I've got it estimated on some other projections at about $4,000 an ounce right now. That doesn't mean that gold's price will appreciate to that, because the key thing for gold to reach its valuation is that investors have to see that the alternative to owning gold and silver is worthless, and that's clearly not the case right now. So I've got a few graphs I'm going to show you, but the one I want to concentrate on is the Wilshire 5000 stock market index. This price index is the most comprehensive index of all companies that are listed on the U.S. stock exchanges. Many people look at this as an actual indicative of total stock market capitalization, and rightfully so. Whatever this stock market index is in the thousands, that tends to be what the actual market capitalization is in the billions. So right now we've got about $31.5 trillion sitting inside of our total U.S. stock market. This blue line is represented as the gross private product that's been calculated by classical economists. It's basically the gross domestic product subtracting all government expenditures, because government expenditures don't really result in any type of growth. It's actually a waste, and so it doesn't really count. Shouldn't really count towards a product. Governments don't produce anything; they only consume. So what's left is just private sector growth, and that's really what the stock market is indicative of, is the U.S. private sector. And you can see here that in the mid to late 90s, we clearly had a stock market bubble. It was very much overvalued to the gross private product. When in times past, in the 80s and the 70s and prior to that, the growth in the stock market tended to trend with the gross and nominal gross private product. And then in the 2000s, again, we had the historic classic credit bubble that had been formed after the dot-com bubble burst in the 2000s. This does not capture the housing market bubble. It just captures the stock market bubble with it, because obviously this is a stock market pricing index. And then you can see the huge stock market bubble that has formed ever since then. That's clearly overvalued. And in a later vid, I will go over in more detail this kind of chart that I'm showing. But my major point is that investors still see the U.S. stock market as the major player to give them a return on their investment. You can see here that in post-2008 and early 2009, investors were very pessimistic about the stock market. The stock market actually became more correctly valued. They had abandoned stocks, and that was when gold and silver started to grow and grow in price. They actually have been growing in the mid-2000s, but this is when gold really started to rise and reach close to $2,000 an ounce post-2009. And then the economy recovered more or less, and so gold went into sort of a semi-bear market until COVID hit, and now gold is in another bull market right now. So the question is, just how high can it go? Well, it'll be as high as investors want it to be. It's up to the investors to decide whether they should put their money in gold and silver right now or not. But the point I'm trying to make right now is that if you believe that we're in a gold market, you're sadly mistaken. Gold has not entered its bull market yet. When it does, it will reach a valuation of around $4,000 an ounce. And that's the point that I want to make. It's severely, severely undervalued. Now, over time, as the economy recovers, this price will drop a little bit, but right now, even if the economy were to recover and stabilize back to what it was previous before the coronavirus hit, with all the money sloshing around in checking deposits and currency in circulation, gold really shouldn't be valued anything less than $3,000 an ounce. But now in times past, you can clearly see that in times of economic growth, gold really traded at a significant discount to its valuation. So here I've got gold trading at about 30% of what it should be valued in the mid-1990s, because during the mid-1990s we witnessed such explosive relative growth in the U.S. economy. We also experienced a massive asset bubble in the stock markets, and so that became a lucrative investment which drew away from gold until that stock market bubble burst. And then with the onset of 2001 and the wars in the Middle East, as well as a drop in the stock market, gold began to enter its bull market until the historic crash of 2008, and that's when it really exploded in price and reached its valuation. And once a crisis like that hits, another credit default crisis happens, that's when gold will be valued upward. The other thing that can trigger gold's price to appreciate significantly is if we have a rise in the consumer price index. And indeed, in the last 2 months, we've been seeing a high CPI index, year-over-year rate. So the year-over-year inflation rate has reached 1%, which is nothing spectacular, but the last 2 months have reached annualized rates of 7% consumer price inflation, which, given the nature of the debt that we have taken on to fight COVID, and even before then, our debt to GDP ratio is about 400% when you take into account all debt that's in our economy right now, which is absolutely catastrophic. If we were to have 7% consumer price inflation, with that, there's no way we would survive as an economy. We would see historic debt defaults. We would see rising interest rates, and we would see a new level of poverty. As the economist Ludwig von Mises put it, we would rediscover what hunger is. So, just take that for what it's worth, and it's quite humbling. So there's definitely some bullish indicators for gold right now, particularly with the valuation models skyrocketing upward. It's just that with the initial bounce back in economic growth, gold may actually flatline around the 2000 era, hold around there, $1,800. Maybe it could go up a little bit, but it will not approach this valuation until it becomes painfully clear that there is a significant breakdown in the economy, and this is actually a market breakdown not caused by government intervention. I think right now many investors are giving a pass on the breakdown of the economy because it is forced upon us by the government. So they're just saying, well, it's the government shutdown for dealing with the pandemic. It's not really a problem with the U.S. markets themselves. And because of that, they're not pricing gold appropriately. So now is a very good investment opportunity for gold, but you would have to wait another couple of years or so until the real economic crisis hits. And when that crisis hits, we should see gold explode in price and approach its valuation. And since it is valued at about $4,000 an ounce now, that will only go up with time, over time, after the economy bounces back. So I would expect that during the next bull market, we're going to see gold appreciate in value significantly, probably double, if not triple in price. So anyway, thanks for listening, and if you like this content, just like my video and subscribe. I'll post other content giving you sort of a breakdown of the way that our economy is functioning right now, and ways to protect yourself financially against that. But right now, the conventional financial tools of just investing in the stock market and hoping for the best is going to lead to dismal failure in the long run. We are going to have to look to more safe havens such as gold and silver to protect our wealth.